How the rich invest differently. Welcome to our channel where we break down the world of finance and investing to help you make smarter money moves. If you're new here, smash that subscribe button and ring the bell so you don't miss our deep dives into wealth-building strategies. Today, we're tackling a topic that fascinates millions: how the rich invest differently. Spoiler alert, it's not just about having more money, it's about how they make their money work harder, smarter, and more tax efficiently than the average person. By the end of this video, you'll understand why regular investors struggle to grow their wealth, how the rich diversify across unique asset classes, and the clever strategies they use to minimize taxes and maximize returns. So, grab a notebook, hit that like button to support the channel, and let's dive in. First, let's talk about how most people, regular, hard-working folks, approach investing. The truth is, most people barely invest at all. Many rely on savings accounts which, let's be honest, are more like parking lots for cash than actual investments. Savings accounts are safe, but they offer virtually no return. With average interest rates around 0.5% and sometimes even lower, your money is barely keeping up with inflation, which has been running at 2 to 3% or higher in recent years. Worse yet, the interest you do earn is taxed as ordinary income, which can eat up 20 to 37% of your returns, depending on your tax bracket. That's a losing game. For those who do invest, mutual funds are a popular choice. These are baskets of stocks or bonds managed by professionals, but they often come with high fees, sometimes 1 to 2% annually, that erode your returns over time. Plus, many mutual funds fail to beat the market. A 2023 study by S&P Global found that over 85% of actively managed mutual funds underperformed their benchmarks over a 10-year period. That's a tough pill to swallow. Then there's the allure of picking individual stocks. Regular investors often try to beat the market by buying hot stocks like Apple, Tesla, or whatever's trending on social media. But here's the reality: stock picking is a tough game. Most retail investors lack the time, expertise, or resources to consistently outperform professional fund managers, let alone the market itself. Studies show that individual investors who trade frequently tend to underperform the market by 1 to 2% annually due to bad timing and high transaction costs. Exchange-traded funds, or ETFs, are a bright spot for regular investors. ETFs are low-cost, diversified, and track market indices like the S&P 500. They're a fantastic way to invest, but many people make a critical mistake. They move in and out of ETFs, chasing short-term gains instead of holding them for the long haul. Data from Vanguard shows that long-term buy-and-hold strategies with ETFs can deliver annualized returns of 7 to 10% over decades, but frequent trading often cuts those returns in half. And then there's crypto. In recent years, regular investors have poured money into Bitcoin, Ethereum, and other cryptocurrencies, hoping for massive gains. While some have made fortunes, crypto is wildly volatile. For every success story, there are countless others who've lost big. The rich? They're not betting the farm on crypto, they're playing a different game entirely. So how do wealthy investors approach the game? The key difference is diversification across highly differentiated asset classes. While regular folks might stick to stocks or mutual funds, the rich spread their wealth across public equities, private equity, real estate, precious metals, and even municipal bonds. First, public equities. The wealthy invest heavily in the stock market, but they do it strategically. Tax loss harvesting involves selling losing investments to offset gains elsewhere, reducing your tax bill. Direct indexing allows investors to own individual stocks in an index-like portfolio, while customizing it to minimize taxes or align with personal values, like avoiding certain industries. These strategies can boost after-tax returns by 1 to 2% annually, a huge difference over decades. For $1 million portfolio, that's $10,000 to $20,000 a year in extra returns just from being tax smart. Next, private equity. Unlike regular investors, the wealthy have access to private equity, investments in privately held companies. These can offer higher returns than public stocks, but come with higher risk and less liquidity, meaning you can't easily sell your stake. Private equity funds often invest in growing businesses or buyouts, aiming for returns of 15 to 20% annually, compared to the stock market's historical average of 7 to 10%. However, you typically need millions to get in the door, making this a playground for the ultra-wealthy. Then there's real estate. The rich love real estate, and not just their primary homes. Real estate offers steady cash flow from rent, tax benefits like depreciation and potential for appreciation. For instance, owning an apartment building can provide monthly rental income while the property's value grows over time, and depreciation lets you write off part of the property's value against your taxes, even if it's appreciating. It's a win-win. Precious metals like gold and silver are another favorite. These act as a hedge against inflation and economic uncertainty. The rich typically allocate a small portion, 5 to 10%, to metals to protect against market downturns. Finally, municipal bonds. These are debt securities issued by state and local governments, and they're a favorite among the wealthy because the interest is often tax-free at the federal level, and sometimes at the state level too. Munis provide steady, low-risk income, making them a great way to balance a portfolio. The key takeaway? The rich don't put all their eggs in one basket. They combine assets with different risk and return profiles to create a portfolio that's both high-returning and resilient. For example, a portfolio with 60% stocks, 30% real estate, and 10% gold might return 8% annually with half the volatility of a stock-only portfolio. That's the power of diversification. You get solid returns with less stress. When you invest in multiple asset classes, they don't all move in the same direction at the same time. This mix means your portfolio's overall return is roughly the average of each asset's return, but the risk, how much your portfolio swings up and down, is much lower than if you only invested in one asset class. That's the power of diversification. You get solid returns with less stress. Next, let's dive into one of the wealthiest investors' best-kept secrets: how they use their portfolios to live without selling assets. Here's how it works. Let's say a wealthy investor has a $10 million portfolio of stocks, real estate, and other assets. Instead of selling $500,000 worth of stocks to buy a vacation home and paying $75,000 in capital gains taxes, they take out a low-interest loan using their portfolio as collateral. Interest rates on these loans are often just 2 to 4%, and the interest may be tax-deductible. They get the cash they need without selling assets, so their investments keep growing tax-free. For example, if their portfolio grows at 8% annually, that's $800,000 in growth on a $10 million portfolio. And they don't lose a penny to taxes by selling. It's a brilliant way to access wealth while keeping it invested. But it gets even better. When wealthy investors pass away, their heirs benefit from a tax rule called the step-up in basis. Here's an example. Suppose someone buys a stock for $100,000 and it grows to $1 million over their lifetime. If they sold it before passing, they'd owe capital gains tax on the $900,000 gain, potentially $180,000 or more. But if they hold on to it until death, their heirs inherit the stock at its current value, $1 million. If the heirs sell it immediately, they owe no capital gains tax because the basis, the original purchase price, is stepped up to the value at the time of death. This is a massive tax break that helps the wealthy preserve their wealth across generations. For a large portfolio, this can save millions in taxes, ensuring more wealth passes to the next generation. So, what can we learn from how the rich invest? First, diversify across asset classes, not just stocks but real estate, bonds, and even small allocations to precious metals if it suits your goals. Second, focus on the long term. Buy and hold strategies with ETFs or index funds can outperform frequent trading. Third, explore tax-efficient strategies like tax loss harvesting, even if you're not ultra-wealthy. Many robo-advisors now offer this for smaller accounts. Finally, if you're in a position to access alternative investments like real estate funds, consider them for diversification, but always understand the risks and fees. Now, not all of us have millions to invest in private equity or real estate funds, but you can still apply these principles. Start with low-cost ETFs, hold for the long term, and look into tax-advantaged accounts like IRAs or 401ks. Over time, these small changes can compound into big results. For example, investing $10,000 in an S&P 500 ETF at 7% annual growth could grow to over $76,000 in 30 years. That's it for today's deep dive into how the rich invest differently. If you found this video helpful, please hit that like button. It really helps us reach more people, and subscribe for more weekly insights on building wealth. Now, we want to hear from you. What's one investment strategy from this video that you're excited to try? Or do you have a favorite investment you're already using? Drop it in the comments below to join the conversation. For more tips on building wealth, check out our other videos and we'll see you in the next one. Keep investing smart.